Welcome to the daily update, where I'll go over the action in the market for Tuesday, October 3rd, and then we'll see how things look for Wednesday, October 4th. We had a pretty significant down day. We've kind of left that longer term trend line in the rear view mirror now. We're below the 200-day exponential moving average. Could it be that we're getting ready to test the 200-day simple moving average? That's a big line in the sand as far as the market is concerned. If we drop below that and close below it, that's going to turn things much more negative. Now, on the positive side, we have some things that are happening. Growth is still hanging in there for right now, but there's a lot of political uncertainty. There's real worry about interest rates going up. The dollar continues to be strong. Oil is causing inflationary concerns. So there's a lot of things for the market to be concerned about. But at the same time, the market likes to climb a wall of worry. So just about the time we think it's going to hit bottom and go up, it keeps going down. And when it keeps going down, we think, oh, it's never going to stop, only to have it stop and turn and go the other way. So we have to be ready for that at all times. Let's go back and talk about what happened. Right at the open, we had a lower open. This is because the JOLTS jobs report came in really strong, or a lot stronger than what the market thought. And that's producing some good news as bad news right now. And this might mean that depending on the other reports that come out this week, what's the Fed going to do? Are they going to have to raise interest rates again? The employment situation is still looking pretty strong. So we did have a lower open and prices bounced up. We almost got to the daily pivot at 42.83. Then we fell below excuse me, we fell below S1 at 42.66 and then quickly went down to S2 at 42.43. Prices then were able to find support. It's kind of interesting. We were at this 42.75 level. Now in Tuesday's session, we were at 42.25. These round numbers are kind of interesting. They might have to do with strike prices. We did find support at 42.25. We rebounded back up to S2. We never got down to S3. We were still a ways away from that. And then we declined back below 42.25. We closed slightly above 42.25. So we were down 1.37% on above average volume. And I've already kind of gone through our technicals, and I'll show you some of the charts there. It's about inflation, interest rates, growth concerns, economic concerns, what's happening with China. There's just a lot of things to worry about right now. And October is not necessarily a strong month. It's better than September. And sometimes we have really good Octobers. And we're still just getting started with October. So we'll have to see if the market can recoup, or is it going to continue to head lower? Some comments. The JOLTS job openings report, it was stronger than expected. That pushed interest rates up and that freaked stocks out. There's growing concerns about the budget deficit. The budget deficit's been around like ever since the late 90s or something. And then because interest rates are going up and they have to borrow money and pay interest, that's starting to cause some problems about how to fund the deficit, where you get to the point where there's so much debt that all of it's going for interest payments instead of actually paying down the deficit. But this is nothing new. It just didn't magically appear on Tuesday. The dollar is up at the 107.35 level. They started to push it down a little bit. There's some speculation that Japan, where the yen has been really weak compared to the dollar, that they might have come in and tried to intervene to stoke up the yen and push down the dollar. Nonetheless, the dollar was up on the day. Kevin McCarthy, who was the Speaker of the House, he's been dismissed. Now they're going to be going through a process of picking a new Speaker of the House. And my understanding, it's kind of like picking the Pope. They just start voting and voting and voting until they finally get enough votes to actually pick somebody. They don't blow black smoke or white smoke like they do at the Vatican, but it's kind of a similar process. The VIX finally closed above 20. And so we're seeing some increase in fear. Now, above 20, that would often mark a bottom, but we can go a lot higher than 20 with the VIX. Growth is continuing to hold up on a relative basis, and I'll show you that. Microcaps, they're setting a new 52-week low. They're dropping further below that 100 level. Then our list is pretty long now in the short term. We have the short-term advanced decline ratio, the 20-period exponential moving average, the Stochh RSI, the Williams percent R, the CCI 14 and 20 now. They're both on here. The stochastics, the standard deviations chart, the RSI based on 9 periods, and the short-term version of the boom indicator. And I'll show you all these charts. Intermediate term, also having a growing list now. The TTM squeeze, and I have 2 different charts to show you there. The VIX, based on, it should be based on, let's see, the VIX, yes, based on 9 periods. I get this and the regular RSI mixed up. The 50-period exponential moving average, the S&P McClellan oscillator, our PMO studies, the BPI, this is one I've been watching for. We're starting to get extreme negative. We could still go lower, but this often marks a pretty good bottom, especially when we finally bottom out and then start to turn and go back up and cross back above 30. We're watching the Sean trend meter. That's still continuing to improve. The S&P 50-period simple moving average study that I'll show you. And then we're going back to this current scenario that we've been on for about a month, that the economy is stronger than expected. The Fed will need to keep rates higher for longer. In fact, they might even have to raise interest rates, keeping an eye on China and keeping an eye on the price of oil. The dollar was up and interest rates were up, and both of these together are pressuring stocks. We have 2 on our list now. The 30 to the 5 and the 10 to the 5 have gone back to being normal. We still have the 2 important ones, the 10 to the 2 and the 10 to the 3 month. That's what most people watch, specifically the 10 to the 2 year. I tend to lean more towards the 10 to the 3 month. Nonetheless, those 2 are still inverted. Sentiment, we're getting extreme. People are starting to freak out a little bit now. We're down at 17, all the way down from where we had been at 28. Our trend is negative, can't deny that. The ADX is above its moving average, both in the short and intermediate term. They're both above their moving average. Our bias is negative, and I'm keeping our momentum at mixed for right now. We've been chopping around, being real indecisive for the last few days. Tuesday's session was the first time we saw any conviction in a few days, and it's going to be, what do we do with the 200-day simple moving average? If we fall below that, then yeah, we're full-blown negative. We can bounce up off of that. We might see some more positive things start to develop. The economic reports, we only had the JOLTS job openings. They expected it to go down. It actually came in up 9.61 million from the 8.9 million that we saw last time. Here's a chart showing how it really spiked back up, and that freaked out the market, the bond market, every market. Okay, and then we are ticking up with the 10-year yield. We're at 4.8% now. This yield has gone up really fast, and we're above that 4.02% level. So this is producing some growth concerns within stocks. Here's an intraday chart where we did come down a little bit. We came right back up to the daily pivot, almost there, enough to fill the gap, and then we were off to the races to the downside. This is after the JOLTS job report came out. It comes out a little bit later, and we shot down below S1, S2. S3 was down here further. We came down to this 42.25 level, tried to bounce. That wasn't really happening. Came down and set a new daily low, and then saw a little bit of choppiness above the 42.25 level going into the close. We're still kind of hanging in there as far as growth and value. They were both down, but one is not necessarily outperforming the other on this chart. Where we're continuing to see some strength is the S&P growth to value ratio. We actually finished up when you compare the 2 with each other, and going back to about the 21st or 22nd of September, we've been seeing some growth coming in here, outperforming, which may be happening under the surface with the smart money coming in and buying growth, realizing that at some point the market's going to bottom out and begin to go higher. This is just something to speculate on now. We don't know if this is going to happen. We have no confirmation of that yet based on our charts. But you also look at growth versus value, the end of day version, where we actually turned up just a little bit. We're not breaking out, but we're holding up for the time being. Here's our trend above the moving average, above 20. The red line's on top and now going back up. That's negative. The same thing with the short term, above the moving average, above 20, red line on top and advancing. We're keeping an eye on the VIX, which is now starting to go up, which is more of a historical norm that we're going in right now. It doesn't mean we're just going to go straight up. We're going to have periods of time when it might come down if we stick to this average. Looking at the VIX, where we are coming right back up with the line chart, we actually, I guess we didn't close above 20. We hit above 20 on an intraday basis, but then we're able to close slightly below 20. I was looking at a different chart when I was evaluating this, but we're seeing a real pickup in the volatility of the VIX. It's really going up, both with the line chart and the bar chart. And here's the VIX RSI based on 9 periods, meaning that we've probably gone up a little far fast. Now, we could still go up even more than this, but this sometimes suggests at least a short to slightly intermediate term exhaustion for the VIX going up, which may give some support to stocks. We're also seeing this fear gauge continue to really go up currently, and the VIX to VVIX ratio is going back up. That's negative, but this is interesting. We're turning back down with our 5-period simple moving average of the equity put call ratio. Now, we've been pretty choppy as it's going back 5 periods and calculating all the different things that have happened. So we don't necessarily want to rely on this. We want to see, is it going to continue and drop below the 0.8 level? Longer term, though, the equity put call ratio is still going up, and that's negative. The Ulcer index is continuing to go up, and the advanced decline line is really showing some weakness. We drop below the moving average based on price. We're continuing to decline below the moving average based on volume. And this is where we saw a real expansion of the new lows. So we're really declining with our 5-period and our 10-period, which is showing internal weakness. And here's the short-term advanced decline ratio. That's the blue line, starting to get extreme negative. The red line, which is a little longer term, it is not there yet, but it is still negative. Accumulation distribution, still below a declining moving average. We're going to want to see this turn back up to turn more positive. This is looking a little more positive. We're seeing the Sean trend meter actually advance a little bit. It's still negative, but showing some improvement. And we're going back down now with our ratio between risk on and risk off. The cumulative NYSE advanced decline line is still falling down and breaking to new lows, at least based on this chart. We're also declining well below the trend line with our regular advanced decline line, also breaking down below the 50-day moving average and declining with this NYSE advanced decline line. We're looking at the common stock only NYSE advanced decline line. We're coming back down to this previous low based on price. We haven't quite reached there yet based on volume, but when you take this as it's moving, it is negative. We finally closed pretty well down below this upward sloping trend line. This had been a line in the sand for a few days. You see this red line here? That's the 200-day moving average. We're wondering, is that going to be tested? Will it hold? If it doesn't hold, yeah, we're going to turn a lot more negative than we already are. But if there's a chance, we might be able to bounce up off of this. Volume is starting to pick up, and we're seeing both of these lines cross above the midpoint. So that's showing that we're seeing more average volume picking up. The Stochk RSI is still extreme negative. This and the following charts are all of our short-term indicators. The Williams percent R is also extreme negative. The CCI 14, just barely extreme. It just got over being extreme, was trying to recover from that, and now it's going right back in. Where the 20 period never did get back to being more normal, it's still extreme negative. Our stochastics, we are looking pretty extreme negative in the short term. We're turning back down in extreme negative in the intermediate term. We're rolling over a bit after trying to rebound in the long short term. So this is negative overall, but oversold. The force index didn't come back down to the Keltner band, is below the midpoint and declining. That's negative. And here's the boom indicator. This measures how far away are we from a moving average. We have a 20 and 50 and 200-day moving average. Well, we hit the 20 first, and we're starting to get extreme negative there. Maybe we've gone down a little far, a little fast. We are declining with the 50, and we're starting to drop below the midpoint with the 200. The short-term moving average rainbow, we're seeing a rollover of these ribbons in here, which is doing some technical damage. Here's the intermediate term, rolling over a little bit, but not as fast yet. The RSI based on 14 periods is just barely getting extreme negative, where the RSI based on 9 periods is extreme. Here's a chart that I usually include as part of the possible positive scenarios. We're not seeing this for the mid caps and the small caps, but we're starting to get extreme negative with the 50-day moving average of the S&P 500 stocks. The Swenlin trading oscillator turning down based on price. We're pretty much flat based on volume, so these are not necessarily confirming each other. The go no go system has gone back to deep purple. That's negative. Here's a shorter term look at the TTM squeeze. We're coming down to this black line. Now, I drew this black line. There's nothing magical about it. Where you get some context is I just look at, okay, where did we bottom out before? And that's where I drew the black line. Well, we're coming down to that level now. And we haven't been down here in 2023. We saw that at the end of 2022. If this is going to take a stand and start to go back up, it's going to have to hit bottom pretty soon. This might suggest that we're seeing a convergence upon the 200-day simple moving average. The balance of power is negative and declining. We're getting extreme with our 20-period and 50-period exponential moving averages and still declining with our 200. Here's the BPI starting to drop below 30, and this could still go lower, but at some point it might bottom out, and when it crosses back above 30, that is usually a positive sign. But we're not there yet. The McClellan oscillator for the S&P 500 is back to extreme negative, and we're declining with the summation index based on price and volume, and possibly might come down to this extreme negative reading with the volume. The NYSE summation index based on price and volume both continue to decline. And we're turning back to negative with the Elder Impulse system for the S&P. The ease of movement, haven't shown this in a little while. We've been below zero and just kind of chopping sideways. Now we're starting to pick up some more steam. The Erin, haven't shown this in a while. The sellers are pegged at the top, that's the red line. The buyers are decreasing. So the oscillator on the bottom measures the difference between the two, and we could make a case that we're getting either at or close to an extreme negative reading with this. Here's our 200-day simple moving average study, declining and breaking below these previous lows. We're also breaking below these previous lows and coming down to possibly, we're even below that a little bit with the 50-day moving average study. On a momentum basis, we are a negative across the board. The PMO is declining, both based on price and volume. With the PMO studies, we're getting extreme negative with the PMOs that are rising. The buy signals are extreme negative. We're still headed lower with the PMOs that are above zero and close to going extreme. We're declining with the NYSE bullish percent index, and not necessarily extreme yet. Where we had seen some hope in the NASDAQ 100 bullish percent index, now we're starting to see it turn more negative. The slope oscillator is still negative, but getting down to where time's passed, it sometimes bottoms out. The MACD also still negative and possibly getting to some kind of a bottoming point, but it's not there yet. So all of our oscillators, short, intermediate, and long-term, we are negative. And now we broke below the 200-day exponential moving average. Could it be that we're going to test the simple moving average? We're getting down to the third standard deviation, negative third standard deviation with our standard deviations chart, suggesting that we're going down pretty far, pretty fast. But in the longer term, we're seeing these purple lines begin to roll over more and head down. That's negative. The parabolic SAR is negative. We're well below the 100% retracement level. If we get a fire underneath us and we start coming back up, this level may act as resistance. The longer we stay below this and then try to come back and test it, the more strength it's likely to have. And we're also below the 61.8% retracement level. Are we going to come down and test this 50% retracement level? We're coming down to this longer term fib level. This is about where, kind of, sort of, where the 200-day simple moving average is at. So we have a little bit of room there still. We're dropping below 100 and setting a new 52-week low with the micro caps. We're well below the long-term trend line now after we battled it out for a few days. So far, prices are losing that battle. And this was put out by David Keller, where he said that this is a confirmed head and shoulders top once we broke below this range. I haven't updated this chart in a few days, but it's coming closer to this red line. The Heiken Ashi is negative. The Kegi is negative and going pointed down. The Renko is negative. The 3-line break is negative. And the equal weight index is underperforming the weighted S&P 500. But we're still hanging in there a little bit with our ratio. The mega caps aren't quite rolling over yet. They're seeing some weakness, and that could change at any time. But for right now, they're hanging in there. We're well below the 200-day moving average with the Dow and possibly coming down to this S1 level. And we're negative again with the diamonds. We had been looking a little more positive with the NASDAQ 100. Well, that's kind of going out the window now. But we haven't necessarily broke below this previous low. But this is not very healthy for the time being. We're also turning back to negative with the Elders Impulse system, coming down to the 61.8% retracement level with the NASDAQ 100. And we're kind of in no man's land with the NASDAQ. We were looking a little more positive. Well, we gave a lot of that up, even though we haven't broke to a new short-term low yet. And we're coming down below the 50% retracement level. We've been bouncing around here like bumper cars at this level. And then with the FANG index, we haven't broken below this previous 2 lows right here, at least yet. The small caps just continue to show weakness. If we see a few more days of this, we might see a death cross. Wondering about the Russell 2000 small caps. Is this a head and shoulders top? Right now, that appears to be likely. We're getting extreme negative with the RSI, but our momentum with the MACD is still negative. And the Elders Impulse system for the small caps is still negative. The mid caps also showing some weakness, but closed up off of this S1 level. But for the Elders Impulse system, the mid caps are negative. With the Dow, we're seeing a breakdown based on price. The transports are also going down. Saw a little bit of a tick up with utilities. They were one of the bright spots in Tuesday's session, but they've got a long way to go to feel more love. The 10-year bond yield is spiking up to 4.8%. That's freaking out the market. When the bond yield goes up, price goes down, and we're in a solid downtrend. The 10 to the 5-year, we haven't shown this in a long time. We're just barely positive with this yield curve. The 30 to the 5, which we have been watching for a few days now, it's back to being more normal. And we're still just about at the midpoint with this long-term trend channel going back to 2009. And we're breaking a bit below this arithmetic scale going back to 2009. That's turning things a bit more negative. And here's one that I also don't show all that often. It's a 19-day exponential moving average of the advanced decline ratio. We're starting to get extreme negative based on price, and we're just a little bit above being extreme negative based on volume. The Staples to S&P 500 ratio is declining. Staples also saw some weakness. Other times when we see this ratio going down, that often gives support to the S&P. But we've seen that for a while now, and it hasn't really helped out all that much. Keeping an eye on the U.S. 10-year yield, which is going up. German 10-year rates are going up. The dollar is going up, and so we're seeing a stronger correlation between these two. Then I only have this one growth to value chart where we had a solid down day, but the large caps are holding up, the mid caps and the small caps. They're not rolling over, at least yet. This is negative. The 50-period exponential moving average of the new highs, new lows, we've dropped below zero. We've spent most of 2023 above it in the blue area. Now that's longer-term negative because the black line, which is our indicator, it continues to be below zero. It's producing the 50-period moving average, which is in red, to go down below zero as well. The dollar just keeps going up. It's in the 107 area now. In the financial sector, recent golden cross, but dropping below its 200-day moving average. I don't have the updated calendar yet from Tom Bowley. So how do things look for Wednesday? We're getting near the end of one earnings season and now beginning the next earnings season. The UAW strike is still going on, and the longer that goes on, the more of an economic impact that can have. There will be a new Speaker of the House that will be selected, and who knows how long that's going to take and who it's going to end up being. Student loan repayments are restarting now that we're in October, and that could likely drain some of the economy. Our technicals are negative. We do have a confirmed downtrend in the short and intermediate term, but we're having lots of signals that are oversold. We will be getting the weekly MBA mortgage applications index, the ADP employment change. We're getting another employment report, and the S&P Global U.S. Services final reading of the PMI will be coming out, factory orders, and the big one is going to be the ISM non-manufacturing PMI index. Keeping an eye on all the different geopolitical events. Right now, it's about the dollar, it's about oil, it's about rising interest rates. Here's the updated calendar showing what will be coming out on Wednesday. We'll get weekly jobless claims on Thursday, and then the big employment situation report on Friday. Looking at October 4th for the Stock Traders Almanac statistics, we are positive across the board. Not neutral to positive, but we're in the quite positive category. So historically, it wouldn't be surprising to see a bounce in Wednesday's session. Looking at the green line here with the sitting president who is running for re-election, maybe we're coming into that bounce time historically. And we're also possibly coming into a little bit of a bounce time with the Carson research, with the NASDAQ, possibly a little bit of a bounce. And the S&P 500 during a pre-election year also coming into that bounce time. Doesn't mean it's going to play out this way, but historically that is what has happened. And we're up 10 out of 18 times, or we're down 8 out of 18 times during pre-election years going back to 1950 in the month of October. And then looking at the seasonal chart of Bitcoin, where it really hasn't taken off yet, but if it sticks to how it's acted from 2018 to 2022, it could see some real rise out of this. But if you take all the years together, it pretty much doesn't do anything. Our scenarios, we're still leaning towards the down one. We're wondering, is the 200-day simple moving average going to be tested? We probably are going to do that. How is that test going to work out? That's the question. We're not going with the up scenario. We have no justification for that right now. There are some positive things in the background, but we're not seeing any confirmation yet based on our charts. And we're not going with the sideways trend because we are in a trending environment. So our warning signs, the long-term trend signals, we're still getting further below those. Seasonally and historically, October tends to be better than September. The long-term equity put call ratio is going up, where all of the oscillators that we follow are negative, both for the S&P and the NASDAQ 100. The cumulative new highs, new lows for the NASDAQ are showing weakness. The 3-month yield is above where it was back in 2007 and continuing to go up. And here's a new one, the 50-period new highs, new lows exponential moving average study. That's where the blue area has now crossed below zero. That is longer-term negative. The Russell is still below its 200-day simple moving average, and we're wondering, is it creating a head and shoulders top? The parabolic SAR chart is negative, the vortex is negative, and earnings season is ending and then coming our way at the same time. Positive signs. We have seasonality and setups that are still in the background. The daily special K chart, it's rolling over a bit, but it's still positive. The S&P is still above the downtrend channel upper line. The equity put call ratio is going down. Now that may shift because it's been really choppy lately, but for right now, that's positive since it is declining. The risk on posture is now back to showing more weakness. The Staples to S&P 500 ratio is declining. The Russell, the small caps and the mid caps, as you've seen on their charts, short term getting hammered really hard. Longer term, they're still in a recent golden cross. Small caps might be switching though if we see more follow through weakness. Small and mid cap growth is chopping sideways, but continues to be positive. The financial sector has generated a recent golden cross. So our conclusion, we're negative. In the short and intermediate term, we're in a confirmed downtrend, wondering if we're going to test the 200-day simple moving average. In the short term, we're negative, but becoming more oversold. We can say that same thing with the intermediate term. As long as we're above the 200-day simple moving average, we're still positive in the long term. But if we close down below that, that could shift our longer term perspective. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.